Yes, the crypto meltdown is so bad that it has just taken down two of the biggest names in timepieces, Rolex and Patek Philippe. When the government started giving out stimulus money, interest in investing in alternative assets rose. Non-fungible tokens, cryptocurrencies, and high-end brand names were the most sought after in this class. Then, the Fed started tightening to ease pressure on the demand side. Investors decided that putting their money into something intangible is not appropriate for the down market. They pivoted towards tangible assets like watches. They all queued up for the great triumvirate: the Rolex Daytona, the Patek Philippe Nautilus, and the Audemars Piguet Royal Oak. The demand was so high that the second-hand pieces were trading several times higher than their typical retail prices. Now that we are in a bear market and the Bitcoin lost about 70% of its value, the demand for timepieces, along with other high-ticket goods, is evaporating. Buyers are becoming more cautious. Higher interest rates, the end of stimulus payments, and soaring inflation are keeping people from spending. The biggest reversals have been in that once great triumvirate: the Daytona, the Nautilus, and the Royal Oak. Those same models that experienced the most spectacular gains are now estimated to be about 25% below their peaks. This estimate includes private transactions, though, and may not be reflected in available market data. Buying a Rolex in a store feels like a bargain now. Watches of Switzerland Group, which operates boutiques in Britain and the United States, are seeing supply outstrip demand for some Cartier, Omega, and Tudor models. The secondary market for other luxury goods, such as handbags, is showing the same signs of vulnerability that inflated watch prices did. The most worrying of these is the influx of new, younger buyers. New buyers might seem like a good thing, but do not jump to conclusions. Younger buyers usually support a brand because of the trend and not necessarily as an investment. This equates to having to maintain the image via their marketing spend. Nevertheless, what is happening in timepieces may be a taste of things to come in luxury resale and top-end retail stores alike. Many of the same factors that boosted watches also increased demand in the primary market for sneakers, bags, and fine jewelry. Analysts at Jefferies, for example, have estimated that crypto wealth accounted for 25 to 30% of growth in the US top-end sales last year. Wow. Demand is closely correlated to the stock markets. Forthcoming results from the big luxury houses will likely show strong United States revenues for the first half of the year. Remember that, in large part, these numbers are a reflection of orders and purchases made in the last half of last year. They are misleading. We can expect that the second half of the year will reflect worsening inflation and impending recession. This problem is going to highlight another chronic investing issue. When the economy was just about to crumble, people ought to think of investing rather than holding on to their cash. In a way they did, but the strategy was not effective. People were putting their money towards brands rather than actual assets. We always need a physical and tangible asset in our portfolio. However, a brand is not a tangible asset. The raw materials used for the product's development are tangible assets. And that is what you should hold on to and invest in as a regular part of your portfolio and as a hedge during economic distress. The raw materials. Gold, silver, and real estate are some of the best tangible assets to hold on to. Brands have a place in your life, but not a hedge against economic distress. This is RiskFlex with Noble Gold Investments.